Something big just happened to the Australian property market. 34,000 jobs were lost last month. It's the highest unemployment rate in 4 years. Is it time to panic? In this video, I'm going to go through the data state by state and work out what is actually going on in the jobs market. We're going to unpack what the RBA is thinking. And finally, we're going to tell you exactly what this means for interest rates and the property market for the rest of the year. Let's go. So let's start by setting the context of where Australia is at the moment. It's been a 4 or 5 year journey since COVID hit our shores, and inflation then came in and roared its ugly neck on the Australian economy. And it was the mission of the RBA to jack up interest rates and slow the economy down and get inflation back where it needs to be. The flip side to that is unemployment would go up. That is normal. When inflation's too high and you slow the economy down, unemployment will trend up, and that is exactly what we expected, and it is exactly what we are seeing. But the reason why this scorecard is so important right now, and this is the one line I want you to take away, is we are no longer at full employment for the first time in 4 years. We can say that definitively. And what that means is the RBA are failing at their dual mandate right now game. It wasn't long ago they were failing because of inflation, but inflation is where it needs to be. It's in and around that band. Yes, there's a little bit of upward pressure. Yes, it's marginally too high, closer to 3 than closer to 2, but it's where the RBA expect it to be and in and around that level. But now, unemployment is trending up. It's now at the point and right above where they thought it would go. And if you look at it closely, it's trending the wrong way. This could have game-changing consequences to the direction of interest rates in the months ahead and the direction of property prices too. Let's get into the report card and get into the detail a little bit so you have the answers. Let's go. So what I see here, this is the scorecard that comes out every single month here in Australia. It's called the Labour Force in Australia. It's one of the biggest data releases every month that comes out by the ABS, and all eyes are on it. There's all these traders out there in the CBD that I'm just looking at out here that are sitting there at their laptops waiting, being like, do I go up or down? What do I do? The Australian dollar moves, expectations change, and things adjust on this very scorecard that got released earlier today. And what you can see here is unemployment levels are higher than expected. We're expecting an unemployment rate of 4.3%, but it came in at 4.5%. The number of jobs lost was 33,900 in a single month. That's a little bit high, given over 12 months, we've only lost about 75,000 jobs, but in the 1 month alone that we are in right now, September, we lost about half of that. We lost 34,000 jobs in this last month alone. Trending in the wrong way, a little bit scary when you look at it in a month by month level. There is some good news though. We created 15,000 jobs. That's pretty good. Created 15,000, we lost 34,000. There's some offsetting there happening. Some people are getting jobs, a lot of people are losing jobs. Net, we're down about 20,000 jobs over the course of this month. Also, there's some other positive measures here. The number of hours everyone worked went up a little bit. The participation rate went up a little bit. And there's a few other little nuances in this data release too, but it suggests some level of concern, but no real time to panic yet. And the one takeaway you should know is the monthly jobs scorecard that comes out every month in the middle of the month, it's volatile. Sometimes it's high, sometimes it's low, so you can't read too much into just one release, but the overall picture is very clear. And you can see that when you start looking at trend lines over a period of time, which is available in this chart. Here's the unemployment trend line. What do you see? A gentle increase happening. That goes back to the context setting that I talked about earlier, where I said that inflation base was there. We expect inflation to come down, which we've already had, and unemployment to gradually go up. We've had that. More recently, it's kind of spiked up a little bit too fast. So, bit of cause for concern if that continues. And you can see this in employment growth as well. And everyone, a little secret nugget for you property investors. Employment growth, that is one number to look at very, very closely. But I don't really want the aggregate data when you're looking as a property investor. You want to be looking at employment growth in certain locations. It's actually how we at Alaya find those secret locations that are going to do very well. Mildura, you know why we've been buying there? We've been tracking the economy there on the ground. Griffith, the economy there is doing really, really well, and that's picked up in the employment growth data that you see. And in our analysis of the Darwin property market, before we called it a year ago as going gangbusters, what we were really looking at is the underlying economics of that city, and the employment growth in Darwin was very, very strong relative to itself. And these metrics show you what is happening on the ground. Are jobs being created? And you can use labor force data that is here, really drilled down into Excel spreadsheets, and then there's other measurement tools available. You drop it in the comments below how I do it. That can help you work out exactly what is going on. But nationally, here's the aggregate story, not the story of just an individual location that property investors are interested in. Go check out our podcast to work out what's going to do really, really well in the short run. The aggregate story is the employment growth curve looks like this. So instead of looking like this, where you have solid employment growth every month, it's starting to taper off. And this is what matters, because this is where we are right now. What is happening right now? We ain't creating enough jobs, Australia. We're not creating enough jobs. That is a big, big change to Australian society, and we can kind of say it definitively now. We've got enough data to say that. There are cracks appearing in Australia's job market, and that is going to change our story over the next few months. Let's go through what is going on state by state as well. Let's drill down from the national story down to each individual location or each individual state in Australia. And there's some really, really interesting insights here as well. My big takeaway here when I look at this chart is what I'm seeing is that every single state has such a narrow band of unemployment with each other. That is, the lowest unemployment rate in Australia is at 4.2% statewide. The highest unemployment rate is at 4.7%. They're so close to each other, they can kind of swap around, and it wouldn't make that much of a material difference. You know, data moves around a little bit month to month. But that's every single state across the country. So we all have the same unemployment story and the same labor market story and the same high-level frameworks at exactly the same time. It's a very, very interesting scenario. And it does point to property investors, it points a very, very interesting story. Typically, you'd think, I'm in Sydney here, you'd think Sydney CBD, you think Melbourne CBD, job centres, jobs. But is that really happening right now? Not when Tasmania has the same unemployment rate as Sydney. That's like, ooh, what's going on there? When you go to Tasmania, you don't think jobs, you think lifestyle. You think everyone's chilling, unemployment rates are really high. But that's not happening right now. You're seeing those smaller locations, Darwin, Tasmania, regional centres all around Australia, having really strong levels of employment growth, while metro areas sitting in and around or slightly above where they typically are. That's a very interesting point for property investors to take advantage of. So here's my summary of all of this. Is it time to worry? Let's hear what Governor Bullock has to say about this. She's using other measures than unemployment, hey? Other measures, such as the vacancy rate, have been stable, and leading indicators are not pointing to further significant increases in the unemployment rate in the near term. Uh-oh, that just happened. Not so sure she's right on that. The RBA governor even emphasized that recent monthly jumps shouldn't be overreacted to. She's right on that these data months change month on month, but she's also pointed out that she doesn't expect it to continue. The forward-looking indicators aren't suggesting anything like falling off a cliff anytime soon. We are conscious that the unemployment rate has been drifting up, but we had been expecting that. She's right, that is kind of what's happening. Unemployment rate curving up, and she's not expecting it to be a cliff fall off. If it was a cliff fall off, interest rates will come down very, very quickly. Big worrying sign. We should all panic right now if it was cliffing off. Be like, we saw that in COVID and it's just like, uh-oh, a lot of people out of work pretty quickly. What do I do? Twiddle my thumbs? That's a big, big problem for Australian society. It causes ripple effects everywhere. That's not happening. So while this is a big news story, because it changes the dynamics of where we are right now and changes the 12-month trajectory of property prices, it isn't a, hey, gloom and doom, like it's panic, it's collapse and all that sort of stuff. That's not happening. It's gentle trend increase, but it is big breaking news for sure. And this is the really interesting thing as well. Right now, leading Flint, we are going through a mother of a lending boom happening right now. I know this because Flint has like a few different mortgage businesses that collate up, and every single one of them, and they're large businesses. We're talking about some of the biggest loan writers in Australia. All three of them, 3 out of 4 of them right now are sitting there hitting personal bests by a distance. At Flint Invest, the business that I run, in the comments below you can speak to us, that business has just posted its best month 3 times in a row by a distance. There is so much demand, especially by property investors right now. We're seeing that at Alaya too. So much demand in that Melbourne market right now, and there's so many people snapping up properties quicker than ever. There is a strong momentum in the property market right now. We've talked about that on this channel quite a bit. We're in the middle of the everything everywhere property boom right now, and that is very much there, despite the weakening jobs market. And in fact, here's the crazy thing. The weakening jobs market, it helps property prices. And let's go through why. It's all about interest rates. Jobs at a national level mean a little bit to property prices, particularly if people are panicked and worried, which they're not because this isn't worrying enough. But it means a lot more to interest rates, and interest rates mean everything to property prices in the short run over the next 12 months. It is so big for what's going to change in the marketplace right now. And this dramatically increases the chances of a rate cut this year. Before this release, there was about a 40% chance of a rate cut this year in the month of November. This came out and it went up to 73% right away. That's how bad this scorecard was. It was so bad. We're expecting 4.3, went to 4.5, and the chance of a rate cut just went up a lot. And that has consequences for the property market. And this is what the context setting of where interest rates really matters. This is Governor Bullock's words about the current interest rate setting. And the reason why I share this is going to be made clear afterwards. We don't think monetary policy is restrictive, but we don't think it's accommodative either. It's marginally tight. It's probably a little bit tight, but not much. So what she's saying is the cash rate at 3.6% is a little bit too high, and 3.5% or 3.35% or somewhere in and around that level is the level that you need interest rates to be at to not put pressure downwards on the Australian economy. Right now, the interest rate setting is slowing the economy down, and the RBA is probably cognizant of, unemployment's at 4.5%, starting to look a little bit like cracky, inflation's in band. Why do we have interest rates at a tight level? Should they be asking themselves that? Seems like a no-brainer to be like, why are we having our insurance on the wrong way around? We should probably have insurance at protecting jobs right now. So that is why the increase in interest rate cut likelihood has happened. That is a big news story here. So there you have it, my full take on what this means. If you're a property investor, we're in the middle of the everything everywhere property boom right now, and this scorecard increases the chance of rate cuts, which adds even more spice to the already hot property market. And I'm recording this in early October. The Australian government's just come out with their 5% deposit scheme nationwide that's added even more fuel to the fire right now. We could be in for a cracker year, and this scorecard just means higher property prices in the next 12 months.